you. All right. Okay, we've got some great information for you tonight. I hope you're excited. I am. So, yeah, look, we've been doing this a long time, 14 years. You know, if you do something a couple of thousand times, you generally get pretty good at it. So, you know, if we can help you guys, happy to chat afterwards. Really, the focus of our business is finding the homes that you couldn't, tapping into the hidden market, and finding and buying in growth markets. That's really the core of what we do. Okay, enough about us. So, something we get asked a lot is what's the future of property prices in Australia? Are we in a property bubble? Can we expect a collapse? Is there another boom coming? So let's find out. So this is pretty technical. The future of property is a lot more certain than most people understand, and that is because most investors don't study history. We are very keen students of history. This is our description of the real estate cycle. We'll take you through this step by step. And it's very important. We believe fortunes are built on market cycles. The property cycle that we've got here typically occurs across 18 to 20 years. So it unfolds kind of slowly. If you take adulthood as being 20 years old, you only really get 3 of them in your lifetime. So sometimes they're a little bit easy to miss. So this cycle clearly historically repeats itself. Australia doesn't generate its own cycle. It really follows the US cycle by about 12 months. So we've documented this as 4 phases, 24 stages, and these stages do overlap. They're not exactly discrete. We've identified these cycles going back for many decades, and based on history, what we're expecting to see is some very good growth over the next 7 years. This cycle information, there's a lot of detail here. It usually takes us about 40 minutes to get through this. We're giving you an abridged version because it's so important. If you want a detailed version of this, let us know on the feedback form and we'll be in contact with you and we can give you more details, but we'll whiz you through it. So, importantly along the way, we're going to see exactly where we are today and what we can anticipate over the next 5 to 10 years. So this is the first phase of the property cycle. It's the recovery value opportunity phase, and this will, if you've worked professionally and you've been an adult during the GFC, this will probably resonate, and you'll cast your mind back and you'll be able to relate exactly to what we're talking about here. So we're going to begin the property cycle by looking at the very end of the previous cycle. So you can see stage 23 there. Stocks actually always recover before property. So recovery starts in the share market first, before property. We see stocks start climbing, and we saw the Dow and the S&P in America. We saw them begin their recovery rally in about 2009, 2010, coming out of the last cyclical bottom, which was the GFC. Stage 24, around 2011, we see fear receding, optimism returning, and sentiment shifts from fear to more to opportunity and greed. So we're back to stage 1, 2011, 2012, ready for the next boom, and this was the first phase of the new cycle. So one of the first things we see early on in the cycle, stage 2, again around 2011, 2012, is we see rents improve. And one of the key reasons for that is that many people had to sell their homes during the GFC or during these cyclical bottoms. They now need to rent, and we actually see increased rental demand at this time during the cycle. Then we move into the second phase, which is the first upswing and return to growth. And this is exactly where we've been over the last 6 or 7 years. So this should really resonate. This is exactly where we've been. So stage 3, 2012, undersupply. We see vacancies fall, we see rents rise. And typically we see a weak economy, rising unemployment, a lack of housing credit. And many people, again, can't buy property. They're locked out of the market, they can't get debt, and this drives them back to the rental market and leads to increased rental demand. There's also upward pressure on rent from a growing population and lack of builder credit. And it was interesting, around that time, around 2012, we were buying for clients in Sydney getting 6, 7 and 8% yields on property in Sydney. It seems hard to believe now, but that was the pressure on rent, and that's where rents were back around that time. Stage 4, 2012, 2013, we see high prices for established buildings, and because rents increase, banks are actually more willing to provide credit based on the higher returns. So investors, in turn, are willing to pay more for established buildings. The time it takes to sell reduces, days on market reduces, prices rise, and the economy begins to recover. Stage 5, it becomes more profitable to build. Rising prices increase margins for developers of new housing. So you see a lot more development in the market. And that's more or less what we saw around that time, around 2012, 2013, where we saw stage 6, a rapid expansion in new construction. So particularly around Sydney, Melbourne and Brisbane, we saw building approvals increase. We saw construction increase significantly. You saw a lot more cranes in the sky when you were driving around. Stage 7 was really 2014 through to 2017, where we saw an expansion of banks, credit providers and lending. So lending becomes easier. And then we move through to stage 8, which is easy credit. So typically around stage 8, 2014 through to 2017, we saw credit standards loosen, we saw credit availability increase, and credit providers create new lending products to make access to credit easier, for example, higher LVR products. So borrowing becomes a lot easier. And in this cycle, we saw something quite unusual. We saw that activity in terms of credit creation and credit expansion was somewhat constrained because we saw far higher levels of regulatory intervention via APRA in particular. So stage 9, consumer, business and investor sentiment continues to improve. Typically credit grows during that period as well. That was really 2015, 16 and 17. Stage 10, we saw increased building activity absorb vacant land, and we saw a significant land boom both in Melbourne and Sydney. And stage 11, we saw rising land prices, and undeveloped land prices continue to rise during that time. And so the media will always tell you where we are in the cycle if you look carefully. We'll show you later on, you do have to be a little bit careful about what you take in from the media because they can be quite mischievous, but the media will always tell you where we are. So we saw headlines like this in 2017, cost of residential land really surging. And if you actually look at this chart here, you can see the red line there is residential land lot dollar values in housing estates. So you can actually see how much land for new homes actually increased during that time from 2012 through to 2017, which is that first upswing in the cycle that we've just described. So this was 2018. This is approaching the end of that upswing. And you can see the headlines there. Industrial land values soar. Sydney land prices fall for the first time in 2 years as Melbourne hits new high. The cost of residential land is going through the roof. So that was really the indicator that we're getting towards the peak. And this brings us to where we are today. So this is where we are. It's what we call the mid-cycle slowdown. And we were always anticipating this for around about 2018, 2019, where it more or less timed precisely is what we would think. The mid-cycle slowdown typically lasts about 12 to 18 months. And in the last cycle, this timed quite precisely with the .com crash and the World Trade Center attacks back in 2000 and 2001. So there can be lots of pessimism. We saw a lot of negativity during this time. Some of those headlines that Peter showed earlier, we saw a lot of that. And we never expected the mid-cycle downturn to be serious nor long-lasting, which it's proven not to be. It didn't involve severely falling land value. Value certainly came back somewhat, but it was fairly subdued. So a couple of important things. Every real estate cycle involves at least 2 recessions. A mini recession, like what we've just had over the last 12 to 18 months, that's the first. And a complete cycle runs from one land market peak to the other, and we haven't reached the second peak, and it's some years away. So now I think we've got some interesting slides for you because we're talking about what comes next. So understanding cycles historically, this is what we're certain will occur next. Moving into the third phase, this phase we call the second upswing or boom phase, where property price growth is actually typically stronger in the second upswing than the first upswing. This is the most optimistic part of the cycle. It's really the party phase, and there's going to be a tremendous amount of money made here over the next 6 to 7 years. I suppose it's really a question of, will you participate? Will you sit on the sidelines? That's really up to you. So stage 13, we're anticipating 2020 around now through to 2024. Prices get on the move again. So we've already seen prices on the move late last year in January. We see falling yields. The land boom continues. We typically see announcements of incredible optimism like the world's tallest buildings, which tend to open at or just after the peak. Stage 14, we expect this around 2025. We see interest rates rising. We see lavish government spending for public works. And interest rates rise into the end of the business cycle because central banks are not able to engineer a soft landing. They're slow to raise rates during the expansion, and then they have to play catch up. So we see one of the reasons, the other reason we see that the lavish government spending is taxes are at their highest during this part of the cycle. So that's really the boom in full swing, and that's what we saw during the last cycle around 2004, 2005, 2006. So around 2025, we believe that we'll see again that real estate activity will be frenetic. It's really what you see during that time is peak materialism. So real estate profits are near their peak. We see falling yields. We see the good times really continuing then. And more properties and investments are made on the hopes of future capital growth rather than a decent rental yield. You'll also see peak luxury goods consumption, peak collectibles consumption. So it's around that time that you see peak prices for Picassos and Van Goghs and collectible Ferraris and those kinds of things. So stage 16 around 2026, activity slackens but confidence remains high. That's really the peak of the cycle. Borrowing power is maxed out. There's no further room for property prices to grow. And then we move into this peak crash phase, which is really what we saw during the GFC. Stage 17, foreclosures and bankruptcies increase, lower property sales, lower volumes, lower prices, oversupply. And yeah, we're expecting that around 2026, 2027. Stage 18, we see stocks start to really tank. And we saw the US Dow Jones halve in about 18 months. That was around September 07. And we saw the same with the UK FTSE. So stage 19, we see credit creation institutions contract credit availability, falling construction, bank failures of weaker banks. Stage 20, we see economic activity stall or contract, falling property prices, liquidation of businesses. We actually see around that time a lot of mortgagee and possession sales. So a lot of our clients did very, very well around that GFC period. We managed to pick up a lot of mortgagee and possession stock, which they've continued to hold. And so they did very, very well out of that at that time. Stage 21, we see a wipeout of debts via bankruptcy, falling interest rates. And in Australia in 2010, we saw a lot of large businesses collapse. So Babcock & Brown, Allco, MFS, Storm Financial. And we're expecting that around 2028, 2030. Stage 22, the wreckage is cleared away. And that really brings us back to the beginning of the news cycle. So stage 22, in recent cycles, 2010, 1992, 1974, 1954, we expect that around 2028, 2030. And then we start the cycle over again, the recovery value opportunity phase around 2030, 2031. This is a faster and more simplistic look at the 18 to 20 year property cycle, 2 expansionary phases, 2 recessionary phases, the first upswing and return to growth, what we've just had in the last 7 years, 2011 through to 2018. The 2 growth phases separated by the mid-cycle slowdown, which we're just coming out of now, and then we're moving into the second upswing or the boom phase. So this is really a buying opportunity. It's not ideal to be buying when the market's as hot as a pistol. There's still a little bit of weakness in the market, although things really are starting to heat up. So we would encourage you, if you are looking, to make your move soon. A couple of ideas to prosper in property in 2020. So if you look at what happened to Australian property prices during the last major property cycle, which was 91 through to about 2008, they went up a long, long way. And if you look also at these crises that occurred during that same cycle, they were big news at the time. So there's an old stock market phrase, markets climb a wall of worry. It's very much true in real estate as well. Coronavirus has been around all January, and look at what's happened with property during that time. So January is a holiday month for Australia. We've seen CoreLogic report that Sydney's up over 1%, Melbourne's up 1.2%, Hobart's up 1%, Brisbane's up 0.5%. So the markets are moving in spite of the bad news. This is somewhat like the article that Peter showed. I actually collect these articles. We see unfounded fear all the time, so you have to be very careful of the news that you take in. The media's in the business of spreading negativity, and fear sells way better than optimism. So one of my favourite financial articles, this is Royal Bank of Scotland tells investors to sell everything. This was in January 2016. It talked about a cataclysmic cataclysmic year, a global deflationary crisis, sell everything except high quality bonds. So 2016 was a terrific year for property and for stocks, and if you'd taken their advice, you'd certainly be in a world of pain. So the smart money uses fear and negativity as a buying opportunity, and you can too. So this is that man right there. He's from UniSuper, John Pearce. He was the best, he delivered the best superannuation returns of 2019. So 18%, which is a stellar return. And he's on the record as saying that he sees the coronavirus as a rare buying opportunity, which I think is good advice for all of us. So just another quote, the world belongs to optimists, not pessimists. The pessimists are only spectators. So we need to discount them. So we're buyers agents. We talk to a lot of clients, and often what we hear from Sydney clients is that we hear something like, oh look, Sydney gets all the growth, I want to buy in Sydney. And while there is fantastic buying opportunity in Sydney, we're active around certainly across 6 major capitals. And the fact that, I suppose the statement that Sydney gets all the growth, that's really a myth. What this chart looks at is growth across Sydney, Melbourne, Brisbane and Perth over the last 17 years. And if you look at those figures in the top left-hand corner, you can actually see that Melbourne outperformed. So Melbourne got more growth than Sydney and Brisbane. Sydney and Brisbane were pretty much identical over that period. Perth was a little bit less, but I think the idea that Sydney gets all the growth is certainly not something that you want to believe. And I think the reason that this is important is that, particularly if you're looking for an investment, we certainly buy clients. We buy plenty of homes for clients. We certainly buy plenty of investments as well. And the reason that is an important idea for Sydney is an expensive market for investors. Growth typically follows yield, and on this basis alone, Sydney, you can see there is a very expensive market with the lowest yields in the country at 3%, and that was in December's figures. We had a rate cut yesterday. I really like this chart. What this chart shows is what happens when interest rates fall. And you can see that, not surprisingly, there's a very clear correlation between rate cuts and dwelling price growth. So this is the zero line. Anything above here is positive growth. Anything below here is negative growth. And you can see here that these dots are rate cuts by the RBA. And you can see that there's a strong correlation between when we got those rate cuts and growth that followed soon after. Are homes unaffordable in Australia? One of the other myths we hear a lot. This is mortgage repayments as a proportion of household income. And you can see that they're actually pretty much at long-term averages. In fact, they're a little bit below long-term averages. And we would need a further 6 or 7% rise in the national dwelling price to take repayments or repayment affordability back to its long-term average. So we've got rates that are low, and as a consequence, repayments are a lot less than what they were 5, 10, 20 years ago. So as buyers agents, how do we find high-performing property? We look for catalysts for growth. We use a top-down 3-tier model. There are dozens of factors that we review, and we're really looking at 3 elements: the macro factors, the micro, and the property itself. So you can use this same kind of thing if you're interested in doing so. Some of the macro factors, there's dozens of them, but we look at property cycle timing by city. All the capital cities are different or fire at different times. We look at supply and demand factors, public and private infrastructure investment, demographic changes, all sorts of things. Micro factors, we look at council zoning, local employment generators, socioeconomic factors. And in terms of property factors, there's a whole list there too. The building history, the tenant appeal, the cash flow, owner-occupier appeal. It's very extensive. So feel free to leverage off our methods. It can be difficult on your own. And something we find is we frequently speak to clients. They go off and try and do it on their own, and more than happy for them to do that. But a remarkable number do migrate back and say, look, you know what? I don't have the time. I've been missing out. I need help. It's too hard, what can you come and talk to us? I think it's important to remember that successful people all have professional teams supporting them, and we very much play that role for our clients in the property space. Todd White, they're one of Australia's largest valuation firms. They produce a property clock, which we mostly agree with, not always, but in this instance it's a yes. And it's really showing that most of the capital is rising. So you can see there in the rising market, start of recovery, we've got Sydney, Adelaide, Brisbane, Melbourne. We've got Perth at the bottom and Canberra. So there's good buying opportunities in different parts of the country if you're an investor. I think another big mistake many investors make is confusing capital city returns with what's going on within certain property types in certain suburbs. There's always markets within markets. It's like confusing the share index performance with individual stock performance. So a market may be flat, but there's always sub-markets that are growing or are a bargain. So you can see here, in 2019, Sydney houses did 6.1%, but you can see here that these markets did double that, 2.5, 3 times that, and there would actually be property types that would have actually outperformed that, because once again, that's just an aggregate of what occurred in the suburb. So a very important part of the work we do is just going deeper, going into those markets and really identifying the opportunities within those markets. Same with Melbourne. Melbourne did 4.6. You can see that some of those markets did 4 or 5 times that. And the same with Brisbane. Brisbane did 0.4%. And some of those, there was markets there that did 5%, 6%, 10 to 15 times what the headline numbers showed. It's really, it is important to go into those suburbs, to look beyond what's going on in the city, because you can always find growth and opportunity there. So that's all I have time for. So if you want to find, or if you want us, or if you want help finding a home in the hidden market, or if you want us to find you an investment jewel in the best of the growth markets around the country, come and speak with us. We've got some free ebooks that certainly our clients, we get strong feedback on: how to buy your ideal home for less, how to buy your ideal investment property for less, and how to maximise the selling price of your home and investment property. So if you're interested in those, leave your mobile number on the feedback form. We can text you the links. We'd love to hear your feedback on them. But thank you for listening, and I think we're ready to hand over. Yeah.